The industrial fundamentals continue to be extremely strong. We're seeing record cash releasing spreads this year. That's being driven by continued growth in e-commerce, as well as a new phenomenon, the nearshoring and onshoring demand.
I'm here today with Bill Crooker, President and CEO of STAG Industrial. How would you describe operating fundamentals across industrial more broadly, and how does STAG's performance fit into that picture?
The industrial fundamentals continue to be extremely strong. We're seeing record cash releasing spreads this year. That's being driven by continued growth in e-commerce, as well as a new phenomenon, the nearshoring and onshoring demand. In our El Paso market, for example, we went into the year expecting 30-35% rollover leasing spreads in that market. We ended up leasing 3 assets for 59% releasing spreads. And what happened there, that was a direct impact from the nearshoring that was occurring in Mexico and El Paso markets right across the border. So fundamentals continue to be really strong. Supply is elevated this year as compared to past years. However, that's primarily in the big box, 750,000 square foot requirements and above. Our product, our average lease size is about 150,000 square feet. So we're not really competing with that new supply. And one thing to note in the future is that development starts this quarter as compared to a quarter a year ago are down about 40%. And so those development starts would really impact the back half of 24. So in terms of the near term and the medium term outlook for industrial supply demand dynamic, it's very favorable.
And is STAG seeing clear evidence at this stage of the projected near and onshoring of manufacturing operations from overseas?
Very much so. The El Paso example that I just mentioned is an example of nearshoring. And then if you look at the mega site investments that the U.S. is projecting, or it has happened from 2021 to today, as well as what's projected, and you look at that map, it's really focused on the southeast, where North Carolina, South Carolina, Georgia, Texas, Arizona, and some of the Midwest states. So when you look at STAG's portfolio and you overlay our portfolio where those mega site investments are, it's almost a perfect overlay. So it's very hard to quantify that demand and how much that will impact market rent growth. But I analogize it, compare it to e-commerce, where every year market rent growth was underestimated to what actual rent growth was, because it's very hard to quantify the incremental demand from e-commerce. It's very similar to this near and onshoring dynamic. So it's going to happen, it's real, it's going to positively impact our portfolio and the sector as a whole, but it'll be very hard to quantify.
And how busy do you expect to be in terms of development and acquisitions for the remainder of 2023?
It's an interesting question. The acquisition market has been really quiet up until this point. We are seeing what I call some thawing in the acquisition market. Some deals are getting done with the shorter lease terms, call it the 1 to 2 year lease term with some mark-to-market opportunities. And we're starting to see some opportunities in the 3, 4, 5 year lease term. My expectation is that the acquisition market will continue to thaw. The bid-ask spreads will continue to narrow, and we'll see more acquisitions in the fourth quarter of this year. And that's as a sector, but for STAG specifically as well. Our guidance continues to be 300 to 700, which is wider guidance and lower guidance than what we've historically have. But we feel like we'll still be within that guidance range for this year.